Well, this morning, stocks are muted, fractional losses that we see here as we get ready to open the markets. But with minutes from the Federal Reserve's latest meeting due out this afternoon and those two inflation reports on tap, I do want to welcome in my first guest who can walk us through what we need to know. Joining me now is Mark Hamrick, Senior Economic Analyst for Bankrate. Mark, welcome to the show.
Great to be with you.
Great to officially have you on NYSE TV Live.
I love it. Thanks so much. Congratulations on your new role.
Thank you so much. Well, you are an expert when it comes to interest rates, the economy, and I want to start by asking about these Fed meeting minutes that we'll get later today. What do you expect we'll be able to glean from them?
Well, I can tell you what I'm most interested to learn from them, and whether they'll satisfy my interest is another question. But you know, as one who attends the Federal Reserve news conferences, always have my list of questions ready to go. I think the one thing that people sort of walked away from that news conference that Chairman Powell held was the question, why the urgency, right? Because he's basically saying, we feel like policy's in a good place. We don't feel like this is a make-up rate cut because we paused at the July meeting. But yet, they went with, obviously, the higher of the two perceived options, a rate cut of 0.5%. Obviously, we know one voting member dissented, right? And so I think it'd be good to get some color as to what the discussion was. Why go with something that's a stronger dose of medicine? And as you know, the table seems to be set now. We have data to get through for maybe 2 quarter-point cuts through the end of the year. So obviously we then get a total of a full 1% or 100 basis points. So, you know, give us some context about why the 50 basis points, 0.5%.
Yeah, and we know that the Fed does have a dual mandate. Obviously, controlling price gains or inflation is one part of it, and the other part is full employment. So we'll have those inflation reports, as I mentioned, later this week. What do we need to see when it comes to consumer prices?
You know, inflation was misbehaving for a long time, and we just need inflation to behave, right? And that's the expectation, the headline and core for both the CPI and PPI, the retail level and the wholesale level. The expectation is a gain on the headline for both of 0.1% and 0.2 for the core, excluding food and energy. It helps that we've had a decline in gasoline prices, obviously with tensions raging in the Middle East. That is, you know, a source of some future uncertainty, but we have what we have for the moment. And so if we get as expected on the CPI, year over year would likely go from the previous month's 2.5 to 2.3, and it's expected that core stays at 3.2. That likely gets us to the PCE headline of 2%, and that's where Jerome Powell might feel like almost spiking the football, because, as we know, 2% is the Fed's 2% target.
That's right. So markets certainly are pricing in it. It sounds like economists as well, Mark, or at least from your purview, 2 quarter basis point cuts, quarter percentage point cuts, 2 interest rates or borrowing costs before the end of the year. I believe the Fed has just 2 meetings left.
2 more meetings.
In November and December. Is there anything in these reports or the data that could change that? Any sort of curveball that our viewers should be aware of?
I think we're always on alert for something that changes expectations, right? And so now we know what those expectations are sort of as of right now. But I do think that, you know, we really were breathing a sigh of relief with that employment report last Friday, where, you know, we had a growth scare a couple of months ago, right? And then all of a sudden we had what Austin Goolsbee of the Chicago Fed described as a superb jobs report, right? And so the Fed does not believe that employment is a likely source of inflation in and of itself. We know leading up to 2020, we had a solid job market for many years, and the Fed was undershooting its 2% target. So I think the Fed is really now in a mode where they want to make sure that unemployment does not start spiraling up and being more focused on the maximum employment part of the mandate, because they know that's when the economy starts to sort of come apart if we start having people separated from their incomes with a rising unemployment rate. And I think they believe broadly that, barring something that's truly unexpected or a global development, that inflation should continue to meet their goal.
Several guests have joined me and said that they believe that lower interest rates will benefit risk assets like stocks.
Yeah.
As we know, investors are constantly searching for yield or return. What does that mean for everyday Americans and even investors who do have money, let's say in a high yield savings account, trying to take advantage of those rates of late?
Love the question. Obviously, if you had one complaint about the stock market right now, it's valuation, right? That's key for those with a short-term mindset. At Bankrate, we're more aligned with those who are investing for their retirement, so for the long term, and we think it's a fool's errand to try to time the market. But obviously, if the market falls out of bed at a certain time, that's going to be of keen interest. People have been rewarded for looking at their 401k balances of late and have not experienced anything particularly unnerving. To your question about essentially savings yields that are really something that more Americans need to be mindful of and achieve their savings goals, we're going to have savings rates fall like a feather in terms of the opportunity to capture yield, whether it's on a deposit account like a high yield savings account, a CD of a term ranging from 3 months to 5 years. And I would say this, like trying to counsel people not to time the market, I would say absolutely shop around for the best yield, but you don't need to nail the yield. You just need to play the game, and having an appropriate mix of asset allocation, and I would throw cash into that in the sense of having that in a deposit account. It's still a good time to save. It's always a good time to save because many Americans don't save enough for emergencies or retirement.
Interesting. Now, Mark, in terms of what we can expect from here, inflation data in focus, jobs data in focus, what else are you watching as an economic analyst?
Well, we have an election coming up, and that's going to be important. We know that that has an impact on consumer confidence. People view the health of the economy through their political identification. And with the election being as close as it is, a good part of the American public, a sizable component of the American public, is not going to be happy with the outcome. So that is one source of not only political uncertainty, but policy uncertainty. I think it's a good bet that we'll still have a divided government, and so that hinders the ability of whoever wins to accomplish what they want. Geopolitical events, obviously, in this dramatic time. And then, we'll continue to watch the Fed, we'll continue to watch the job market, the inflation data, as you know, and the strength of the consumer. That's really key when we go into the holiday shopping season.
Mark Hamrick, Senior Economic Analyst at Bankrate. Mark, always a pleasure to have you. Thank you.
Thank you.